When wealth and leverage are hyper-concentrated in a single trade, the entire system becomes exquisitely sensitive to a single catalyst, a shift in sentiment, a minor earnings miss from a key player, or a tightening of monetary policy that makes leverage more expensive. Thus, the AI sector presents a profound paradox. It is simultaneously the market's most credible growth story and its greatest single point of failure risk. Its strength is masking broader economic frailties in consumer spending and employment. Its momentum is sucking oxygen and capital from other sectors, creating a lopsided and unstable market. The terrifying question for the broader economy, therefore, is not if AI is transformative. It likely is, but what happens if this one overcrowded, over-leveraged trade even stumbles? If AI sneezes, there is nothing left in the chamber to hold up market confidence. The contagion would be immediate and severe as the last pool of bullish liquidity evaporates, forcing a simultaneous repricing of risk across every asset class. The very factor holding off a deeper crash today could become the trigger for a more synchronized and violent downturn tomorrow. In this light, the AI boom is not a shield for the average investor. It is a dazzling high-risk insulator that is keeping the market's core instability at bay. For now. Cool. The frenetic volatility on our trading screens is not a spontaneous phenomenon. It is the direct, real-time reflection of a global macroeconomic system showing clear and measurable signs of acute stress. To understand where the markets are headed, one must move beyond the charts and examine the fundamental vital signs of the economy itself. 3 critical indicators: the labor market, systemic political stability, and consumer health are now flashing unambiguous warning signals. These are not speculative concerns, but empirical data points that collectively sketch a portrait of an economy transitioning from a post-pandemic growth phase into a period of significant vulnerability and potential contraction. The market sell-off is not the cause of this weakness. It is the financial market's anticipatory response to it. First, and most critical, is the deteriorating picture of the labor market, which remains the ultimate foundation of consumer spending and economic confidence. The recent headline jobs number showing an unexpected uptick provided a momentary relief rally. However, this is a classic case where the headline obscures a far more troubling trend. The year-over-year rate of job growth has slowed to its most sluggish pace since the economic recovery began. This granular deceleration is the proverbial canary in the coal mine. Historically, when job growth softens to this degree, it has preceded a formal recession 100% of the time. The mechanism is straightforward. As hiring freezes spread, household income growth stalls. This doesn't cause an immediate consumer collapse, but it instills a pervasive sense of economic insecurity that fundamentally alters spending behavior. Consumers begin to defer large purchases, reduce discretionary spending, and bolster savings in preparation for tougher times ahead. This slow-motion shift in behavior is what then tips the economy into a self-reinforcing downturn. The market is forward-looking. It is pricing in this high-probability recessionary outcome now, well before unemployment rates officially spike. Compounding this economic fragility is a visible erosion of systemic political and institutional stability. The analysis of governmental restructuring, particularly within departments like education, is not a political digression, but a crucial assessment of systemic risk. When core institutions tasked with long-term societal functions like financing education or managing public health become subjects of partisan restructuring and operational uncertainty, it directly undermines the long-term confidence necessary for capital investment and economic planning. The specific mention of the student debt crisis moving into the private market is a potent example. It represents a potential transfer of systemic risk from the public balance sheet to the private financial sector, creating new opaque vectors for contagion should defaults rise. Furthermore, the specter of repeated government shutdowns and crises over fundamental services like healthcare injects a powerful element of unpredictability into the economy. Businesses loathe uncertainty. It freezes capital expenditure, CapEx, plans, delays hiring, and promotes defensive financial management. This political kicking the can down the road doesn't solve problems. It institutionalizes uncertainty, which acts as a persistent drag on economic growth and a tax on market valuation. The ultimate convergence point of these first two factors is the American consumer, who is now showing the earliest yet most telling signs of cracking. The holiday retail season analysis is not a casual observation, but a critical leading indicator. The reported dramatic drop in foot traffic at national chains, coupled with the precipitous stock price declines of bellwether brands like Chipotle, is empirical evidence that the consumer retrenchment forecast by the jobs data has already. This is a waterfall effect in its early stages. Weaker job prospects lead to cautious spending, which forces retailers to engage in aggressive margin-crushing discounting to lure shoppers, which in turn leads to plummeting corporate profits. The script's powerful visual of a restaurant stock chart mirroring a crypto chart is intentional. It demonstrates that the speculative froth is evaporating from all risk assets simultaneously, whether they are digital tokens or brick-and-mortar burrito chains. A weak holiday season will not just be a bad quarter for retailers. It will set off a negative earnings revision cycle for Cone of the coming year, forcing a broad re-rating of equity valuations across the entire consumer discretionary sector. Therefore, these three vital signs form a closed, negative feedback loop. Political instability breeds economic uncertainty, which slows business hiring and investment, job softening, which erodes consumer confidence and spending power, which crashes corporate earnings, which further destabilizes the political environment as public anxiety grows. The market is not reacting to any one of these data points in isolation. It is rationally pricing in the high probability that this feedback loop has been initiated. The Federal Reserve is now trapped in this loop, caught between businesses demanding rate cuts to stimulate borrowing and the stubborn reality of economic data that, while softening, does not yet justify emergency stimulus. The Fed's ensuing paralysis, its indecision itself, becomes another weight on the market. In essence, the financial markets have diagnosed the patient, the economy, read the vital signs, jobs, stability, consumption, and are now administering the harsh medicine of lower valuations in anticipation of the sickness fully declaring itself. To ignore these macro indicators is to mistake the symptom, market panic, for the disease, a decelerating, unstable economic system. Amidst the deafening noise of crashing prices and apocalyptic headlines, the single most important task for an investor shifts from prediction to preparation. The market's current volatility is not a puzzle to be solved with a single correct answer, but a complex scenario to be navigated with a robust and flexible plan. The ultimate takeaway from this analysis is not a buy or sell signal for any specific asset, but a framework for developing strategic clarity. This moment ruthlessly exposes the difference between an investor with a plan and a speculator driven by emotion. The historical data, psychological insights, and tactical options presented are not meant to forecast the exact bottom, but to equip you with the tools to make deliberate, unpanicked decisions regardless of which path the market takes next. The foundation of this clarity is built on an unemotional review of historical market psychology and performance. The script deliberately invokes the memory of the 2021 cycle for a crucial reason: to provide a data-driven antidote to the present feeling of unique catastrophe. The historical record shows that even in the most brutal downturns, like Bitcoin's 50% plus decline from its peak, violent double-digit relief rallies are a standard feature, not an anomaly. The 40% rebound in Bitcoin and the 125% explosions in assets like Solana and XRP were not random. They were the market's mechanism for shaking out weak hands and rewarding those with the capital and conviction to hold through extreme fear. This history serves a dual purpose. First, it reframes the current plunge from a game-over scenario into a phase within a cycle. Second, and more importantly, it defines the concrete risk-reward calculus you must now confront. It poses the explicit question: are you financially and psychologically positioned to endure potentially further downside in order to capture a future relief rally of that magnitude? There's no universally correct answer for your capital, risk tolerance, and time horizon. This historical lens leads directly to the fork in the road, the choice between weathering the storm and protecting capital. These are not abstract concepts, but distinct strategic postures with specific required actions. Choosing to weather the storm is an active, not passive, decision. It requires an audit of your portfolio to ensure you have no leverage that could trigger forced liquidation, and it necessitates securing access to stable, non-volatile living expenses for an extended period to avoid selling assets at a loss out of personal financial need. It is a commitment to the long-term narrative, e.g., Ethereum in 5 years in the face of severe short-term pain. Conversely, protecting capital is an equally valid and active strategy. It involves tactical de-risking, not out of panic, but to preserve dry powder for future opportunities. A key, often overlooked tool here is tax loss harvesting, the strategic selling of assets at a loss to offset capital gains taxes, with the potential to repurchase similar assets after the regulatory waiting period. This is not selling low. It is using the market's downturn to improve your long-term tax efficiency and reset your cost basis. A sophisticated move that turns a paper loss into a strategic advantage before the year ends. Ultimately, the script's conclusion that we are at a complex crossroads is a call for scenario-based planning over conviction-based betting. The job is not to be a prophet who correctly guesses the December Fed decision or the exact bottom in Bitcoin. The job is to have a defined plan for the likely range of outcomes. What will you do if the Fed cuts rates and a short-term risk rally ensues? Will you take profits into strength or add to positions? Conversely, what is your trigger and action plan if the sell-off accelerates, breaking the next key level of support? Having these decisions mapped out in advance is what separates a strategic participant from a reactive victim of volatility. It transforms anxiety into a checklist. This preparedness is the signal in the noise. The market's message right now is not a directional one. It is a demand for investors to upgrade their process from one of hope and fear to one of analysis and execution. The volatility is not the threat. The threat is being caught in it without a plan. The opportunity, therefore, lies not in picking the single winning trade, but in emerging from this period of stress with your capital intact and your strategic framework battle-tested and stronger.